want to kind of transition and talk about a property that you guys recently purchased that really piqued my interest, because I'm in Miami right now. We're down here for a while in the winter, but I'm from Northwest Indiana. That's where I live. And, you bought this property in Indiana. It's a multi-unit, 80-unit property. And so I'm curious about this property. You live in California. What interested you about this property? And can you share a little bit about it?
Yeah, two of our partners they own a 56 unit in nearby. And so just through broker relationships, we kind of found this one. And what really piqued our interest was, everyone in 2019 is buying in hot markets, in primary markets, they want to buy in Indianapolis proper, right? They want to buy in Dallas. They want to buy in Atlanta. They want to buy, or kind of in the surrounding outskirts. So we were looking at secondary and tertiary markets. And why would you do that when everyone else is looking in those? So we have a lot going on at ADPI, with our mortgage branch, our insurance company, the real estate agent stuff, the growing Facebook community of 10,000 members. So we have a lot going on. So that group of guys who are running all of these, this other stuff, we're also buying apartments. And so we wanted to take this kind of deliberate approach that was not necessarily a forceful approach. We don't need the income from these multifamily assets. So we wanted to see, how can we get in? How can we do it smartly? How can we find the right deal? And how can we ensure that our investors are going to get paid, and some, things like that. So we ended up finding a deal, 80 unit in a tertiary market, which you're buying in a tertiary market in that kind of time. That's another hurdle you have to explain to your investors. Why there,
Yeah.
So a lot of our investors are people who, like myself, who come from the Midwest, and they understand the appeal to living in a small community that's maybe 40 minutes from a major metro. So having that correlation with some of our investors helped. But then also it has to come with a good story. The asset that we bought is the previous owner lives out of the country and was mismanaging. He had somebody in there that was never in the leasing office, very outdated interiors it looked like a 1980s bomb went off in the leasing office. So, like blue wallpaper and blue crown molding, looked like country kitchen in there. So, those types of things it was just mismanaged, some deferred maintenance. On the outside, it looked pretty good, new roofs and paint. And so it was good, but the interiors had some meat on the bone left. And another thing we did was, and one of my mentors says all the time, you have to be willing to do in this industry what others are not. So they were overlooking where the value is coming from this. So we went, and one of my superpowers I love doing, and I talked about this earlier about networking, I went out to the property. I took the mayor to lunch. I met with the superintendent of the school. I met with the principal and the dean of the school, which, by the way, is across the street. And what we found out is that they're building a new elementary school across the street, and they're renovating the junior high school and the junior high and high school, which are also across the street from this building. So with that value add, we know people are going to be coming from surrounding communities, surrounding counties, and coming in and wanting to live in our units, which is directly across the street. So now we have flags out front, and we can run teacher specials and whatever, and obviously renovating the interiors and making them much more habitable. Putting in a playground. I'm getting bids right now on playgrounds, and we're going to be doing that as well. So it really just comes down to, if you choose a secondary or tertiary market, you need to find the right deal. It needs to be at the right price, because you have your investors in mind, and really just the success of the business plan in mind, right?
Yeah.
But you have to be able to pitch that to your investors as well.
Yeah.
So a lot of moving parts there, but that's kind of why we did what we did. And now we're finding off-market deals. We just submitted an LOI on 80 plus stores in that same area this week, and we're kind of negotiating that to see what's next. It's looking good right now. And then we brought a 94 unit off-market that we're looking at as well. So some people, it's funny too, because some people are saying, You'd be crazy. I mean, Neil Bawa, we both heard yesterday say, don't buy anything for 60 days. Wait to see what happens. Right.
Yeah. Yeah.
And that's fine. That's great. That's good advice in general. But if you get the right price, heavily discounted price, you are very strict at underwriting, which we are very conservative at underwriting, and we will get even more conservative with underwriting than normal. If you have the right verbiage in your purchase and sale agreement for longer contingencies for financing and some other things like that. If you have a property management team in place, which we do, if you know the market very well, which we do, there's still a place for buying multifamily even now. Now, for people who are under contract and closing right now, could be very difficult. I would urge them to, make sure they're contacting their lender on a daily basis, because there can be a lot of retrading going on between lenders right now, and just getting things closed and buttoned up. But thankfully, we're not quite at that stage. So the earliest we would close on anything right now is probably 3 months. So we'll see. I think we feel pretty comfortable, although we're being very cautious as well. About how we're writing our contract and what the expectations are, and we're making sure we are not paying market value for any properties right now.
Oh, exactly. Yeah, it's such a great bargaining chip right now. When everyone's scared right now, that's when you can say, hey, look, we don't know what the market's going to do, so we need a little bit of a cushion here just to insulate us a little bit. I think it was a great point that you made. I just want to reiterate around the motivation level. This guy is living out of country. He hasn't put any money into updating it. Obviously, this is sort of, when you see that there's no recent updates, typically the situation is somebody's checked out. They'd be happy to get rid of this. It's more of a thorn in their side than something that they're actively managing and excited about anymore. So I think, to me, I always tell people the motivation level is more important than almost any other factor, because, that can dictate so much in a deal. So that's a great point.
He owned it outright. He owned it outright too. So
oh, wow.
No debt service means he had no reason to push rents up to market value. So there's the meat there right off the bat. We were able to increase our 1-bedroom, 1-baths by $105 a door.
Jeez.
Yeah.
Yeah, and he's flexible too. He can the terms, he can say whatever terms he wants because there's no lender involved, and he could also potentially owner finance. I mean, there's lots of different options there when somebody owns it outright. So
so we bought it at about $40 a door, and just with the 1-bedroom, 1-baths, they increased by about $19,000 a door, without renovation, just by bumping rents up to market.
So $19,000 across all of them, you're saying?
Across all the 1-bedrooms, yeah. Across
all the wow. So the valuation then, what's the cap rate?
About 6.5 right now.
Okay.
So another thing is too, we went through expenses. So there's one thing to increase your revenue, but decreasing expenses is also what we intend to do. And we started looking at contracts, and we found that we were overpaying something as small as the garbage contract. And this is why we love multifamily, right? Because you're not looking at comps. Your valuation is based on NOI, your net operating income. So if you can reduce expenses or increase your revenue, you can exponentially change the valuation of your property. So give you a quick example for your listeners. We reduced the trash contract bill monthly from $1,200 to $600. So we saved $600 a month. That's $7,200 a year. Divided by the cap rate is increasing the value of the property by $102,000 by changing the garbage contract.
Jeez.
Crazy.
Yeah. So 102,000 from the decrease there, and then you've got the increase of all the 1-bedroom. Did you have to do renovations?
No, so on the 1-bedrooms, we will be, but we only had 10 vacancies anyway. So it's just we're renovating as we go. Whenever someone moves out, we'll renovate them as they come up. But the rents, we bumped up the rents without renovating, actually. So in our underwriting, we underwrote so conservatively that the rents that we are able to get, which we thought were going to be post renovation, we're getting now pre-renovation.
Wow.
So we'll bump those up. We'll run some specials. We'll bump the rents up even more and just kind of test the market and see where we go. But there's a whole bunch of stuff too. Like We could increase the garage rental fees by 10 to 20 bucks a month. Also, now you probably saw we had a drunk tenant actually run into a span of
yes.
a row of 8 of our garages.
That picture, yeah.
Thankfully, they're detached from the units, but that garage section of 8 has to be probably demolished. It was condemned because the cinder block on the back was all busted out too and stuff. So, but we're thinking, you have to think creatively here. So why were there no cars in those garages that night? It was night, so it should have been full. Mm-hmm. So are they either our tenants are not leasing those up, they're not using them, or they're using them not for their cars, they're using them for storage. And so what we found was most of them are using them for storage. So if they're using them for storage and we're charging $25 a month for this huge storage space, where if they were to use a storage space down the road a mile or two, it would be 80 bucks a month. Why don't we just demolish that row of garages and convert it into storage and charge, 50 to 60 bucks a month for smaller units, and just double it, maybe make 16 storage units instead of 8 garages.
Yeah.
So there's all kinds of options.
Yeah. It's all about optimizing what you've got there. That's super smart. And there's a lot of great takeaways in there. I appreciate you sharing that.
Yeah.